Welcome back. Well, let's stick with the current account deficit numbers for a bit more. Just to remind you, it was a very good number. For the Jan-March quarter, the current account deficit actually did not exist. It was in balance. Our imports and our exports, including goods and services, were in balance from a current account perspective. It was just about 300 million that was the deficit. So 0.3 billion is the deficit, or 0.1% of the GDP. Aditi Nayar, the economist from ICRA, has joined in. Aditi, does this come as a surprise, or were you actually expecting a surplus?
Latha, we were expecting a very small surplus of about $500 million or so. So it's not terribly different from that, although obviously having a surplus would have been a bit of a positive news flow. Overall for the year, I think the number is pretty much in line with expectations. You know, we have had this fall in the merchandise trade deficit, which is good news. But I think what we overlook perhaps is sometimes is the fact that the net services surplus has also come down by about almost 6 billion. And I think that is something perhaps that is a bit of a warning sign going ahead.
Okay, but Aditi, what is the sense? I mean, we just yesterday got the trade deficit data for May and the April services data. So now it clearly looks like April was a current account surplus month. So will April, May, June, the April-June quarter be a surplus quarter?
See, typically, when we go back into Q1, we do find that the current account deficit widens quite a bit from Q4 to Q1. That's the normal seasonality. Certainly, we have had much lower than expected merchandise trade deficits in April and May. I think there is a little bit of a monthly variation at play over here, and there may be some catch-up that would happen in June. Like, I'll just give you one example. Some of the sectors which saw a sharp fall in imports in the month of April actually saw a pickup in exports in May. So I think there is some monthly sort of, variations going on that are getting resettled as we are moving into the year. One more thing that I'd like to point out is that, we've had this very interesting situation. We've had the retail strike from the jewelers, and imports have really come to a standstill. But if you look at the production and the exports data for gems and jewelry, that's actually been going up at a very healthy pace. So I think there is still a danger that gold imports may actually pick up in the subsequent months after the...
So what is the current account deficit you're working with for the quarter or for the year?
For the year, we are working with a current account deficit somewhere between $25 and $30 billion. One big sensitivity is going to be exactly where the crude oil price ends up, because that itself could create some amount of, maybe $5 billion up and down in the net oil imports. The gold price has also started going up. We'll have to see how long that sustains, and obviously that's going to depend on a whole lot of global factors.
Okay, so what will this 25 million trade deficit, current account deficit amount to as a percentage of GDP?
So 1.2 to 1.3% of GDP is our expectation for 2016-17.
Right. Okay, that's not very different from what we have scored this year either. Okay, Aditi Nayar, thank you very much for joining us with those details. So that's really the story. Current account deficit is a story of India's improving macros.